You know, sometimes a story just, well, it jumps out and really grabs your attention, doesn't it?
Yeah, absolutely.
And that's kind of how this past week felt. I mean, gold soaring past $3,250 an ounce.
Incredible numbers.
Right. The biggest weekly gain, I think, since 2020.
That's right.
And then you see the US dollar looking, well, a bit wobbly.
Hmm. Yeah, definitely some pressure there.
Plus this whole US-China trade situation. Wow, those huge tariff hikes going both ways.
Yeah, 145% from the U.S. side, 125% retaliation from China, accusations flying. It's getting intense.
It really makes you wonder what's actually going on. It feels like maybe one of those moments where you think, okay, hold on, something big might be shifting in the global financial picture.
That's a really good way to frame it. And that feeling, that sense of maybe a fundamental shift, that's exactly what we want to dive into today.
Okay.
We've got a really interesting perspective to unpack here, mainly coming from Peter Schiff.
Ah, yes. Euro-Pacific Asset Management.
Exactly, chief market strategist there. And for anyone maybe not familiar, he's been talking for years about potential issues. Things like instability in fiat currencies.
Government-backed money, basically.
Right. And the risks of stagflation, maybe a serious weakening of the U.S. dollar. He's been warning about these trends for quite some time.
And he had that post on X, was it this week, that really kind of caught fire.
Oh, yeah. Pretty blunt. He
Yeah.
said the U.S. dollar bonds and stocks are all getting killed.
Oh,
And then America's ride on the global gravy train is about to come to a screeching halt.
strong words. Sets a tone, doesn't it?
It certainly does. And, our goal with this deep dive today is really to understand the why behind a statement like that. What's driving these things? What are the underlying problems Schiff is pointing to?
And maybe what it could mean for, people trying to figure things out.
Exactly. We want to try and provide some clarity, hopefully without getting too bogged down in all the jargon.
Okay, so let's start with that idea he mentioned, the gravy train ending. What's Schiff actually saying about the current U.S. economic picture?
Well, Schiff's view, and it's a long-term one, has been that some kind of significant economic crisis was, well, probably inevitable.
Okay.
Originally, he thought it might be triggered by something external, some kind of shock hitting the dollar from outside.
Right.
But his thinking has evolved a bit. Now he seems to see the problems as more self-inflicted, stemming from imbalances right here inside the U.S. economy.
Self-inflicted. How so? What does he mean by that?
Well, he pushes back against the idea that trade deficits are the main problem. You hear that a lot, obviously.
Yeah, it's often the headline.
Right. But he argues they're really just a symptom. The real root cause, as he sees it, is that the U.S. for many, many years has basically been consuming way more than it actually produces.
Like spending more than you earn, but on a national scale.
Exactly. A national lifestyle funded in part by others.
Okay, I think I follow that, but how did that keep going for so long? I mean, what made that possible?
Yeah, that's the key question. It's been enabled by a few things running in parallel.
Yeah.
Massive increases in borrowing, for one.
Debt, okay.
Selling off assets we own here, shifting a lot of manufacturing overseas where costs were lower, and fundamentally relying on the rest of the world to lend us their savings.
Mm.
In this combination, it allowed Americans, for a time, to enjoy, a higher standard of living, access to cheaper goods, lower interest rates.
And stock prices liked it too, right?
Oh, definitely.
Yeah.
Stock prices benefited from all that capital flowing in. It fueled the markets.
So the gravy train was basically powered by this flow stuff and money coming
Yeah.
into the U.S. from everywhere else.
That's a great summary. Other countries making the goods we buy and then lending us their profits, essentially. That's been the engine.
Okay.
But Schiff's point is that this model, well, it has limits. It can't go on forever. And if this gravy train really does stop, as he puts it, the consequences for the U.S. economy could be pretty severe.
What kind of consequences are we talking about? Like, what would that actually look like?
Well, probably needing to seriously cut back on consumption. Buy less stuff.
Right.
We'd likely need to save a lot more. And we could see interest rates go up quite a bit, especially if foreign lending dries up.
Okay.
Consumer prices would almost certainly rise, partly because we wouldn't have as many cheap imports.
Inflation, yeah.
And stock prices, they could definitely decline if that foreign investment slows down.
Yeah.
So ultimately, Schiff sees a potential for a noticeable drop in the average American standard of living and overall net worth.
And he thinks this is just starting. This isn't some, temporary blip we're seeing.
That seems to be his view, yes.
Yeah.
He really emphasizes this isn't just a short-term thing. He sees it as the beginning of a much longer trend one he expects will probably gather steam.
Okay, let's pivot then to the gold market because, wow, that recent jump, over $250 in just a few days, you said.
Yeah, it's been accelerating fast. I mean, gold's been moving up, especially this past year. But that recent pace, $100 a day some days, that's definitely grabbing headlines.
So what's Schiff's take on why it's surging like this right now?
Well, what he finds particularly interesting is who he believes is doing the buying.
Okay.
According to Schiff, the main buyers of actual physical gold haven't been, say, individual investors piling in. He thinks they've been more focused on things like, well, Bitcoin.
Right, the ETFs and all that.
Exactly. Instead, he points to foreign central banks as being the primary accumulators of physical gold.
Central banks, why would they be buying up so much gold now? What's the thinking?
Schiff's reasoning is pretty straightforward. He thinks they're getting ready for a world where the U.S. dollar might not be the undisputed sole central reserve currency anymore.
A shift away from the dollar standard.
Potentially. So by loading up on gold, they're diversifying. They're preparing for a scenario where gold itself, maybe alongside the euro perhaps, plays a much bigger role in how global finance works. It's a hedge against dollar dominance.
That connects back to the trade stuff with China, right? Does he see a link there?
Absolutely. He actually thinks the trade war is accelerating these shifts.
How so?
Well, as the U.S. market maybe becomes less attractive or reliable due to tariffs and tensions, China is increasingly looking elsewhere. He sees them focusing exports more towards Europe,
Okay.
especially with the euro being relatively strong, and maybe U.S. consumer demand weakening a bit.
Right.
And at the same time, China's shifting where it gets its raw materials from importing more from places like South America, potentially giving those economies a boost while buying less from the U.S.
So where does that leave the U.S. in all this in terms of trade?
Schiff paints a pretty concerning picture there. He argues the U.S. economy is just fundamentally structured around consumption, not production. We buy things we don't make as much anymore. So our heavy reliance on financial assets stocks, bonds that becomes a vulnerability if global trade flows shift away from us.
And the consequences.
He predicts this will lead to significant inflation inside the U.S. As he puts it, you'll have all this money chasing fewer goods available to buy.
You know, he's been banging the drum for gold for a long time, hasn't he?
Oh, absolutely. For decades, he often mentions telling people to buy physical gold back when it was under $300 an ounce.
Wow.
And he loves pointing out how it's massively outperformed the stock market over, say, the last 25 years. He even argues that the whole stock market bull run looks kind of like an illusion if you measure stock values in ounces of gold instead of dollars, because the dollar has lost so much value.
Right, inflation eroding the gains. But his advice now isn't just buy physical gold? That seemed a little surprising when I read it.
It is a shift in emphasis, yeah. His really strong recommendation currently is to focus on investing in gold mining stocks rather than just the physical metal itself.
Okay, why the miners specifically? What's the logic?
He lays out a few compelling reasons. First, he argues that these mining stocks are just plain cheap right now.
Cheap relative to what?
Relative to the price of physical gold itself, relative to their own historical valuations, and even compared to the broader stock market like the S&P 500. He sees them as significantly undervalued.
And why would they be undervalued if gold is surging?
Well, he connects it back to who is buying the physical gold, those central banks. Their demand directly benefits the companies actually digging the stuff out of the ground.
Okay, that makes sense.
Plus, there's another factor, oil prices. He highlights that oil prices have recently fallen quite a bit relative to the gold price.
And oil is a big cost for miners.
Huge. It's one of their biggest operational expenses, fuel for trucks, equipment, processing. So if gold prices are high and oil costs are relatively lower, their profit margins can expand dramatically.
Leverage.
Exactly. This combination, in his view, creates the potential for much, much higher percentage returns from the mining stocks compared to just holding the physical gold. Gives an example. Like if gold hits $4,000 an ounce,
Yeah.
holding physical gold gives you a nice gain, obviously. But he thinks certain mining stocks could potentially go up, say, 5 times in value in that scenario.
Wow, that's a huge difference in potential upside.
It is. And he points out the sort of irony that some analysts were actually downgrading gold stocks earlier in 2024 when gold was only at $2,000. They completely missed this huge run-up.
So Wall Street maybe isn't seeing this opportunity.
He suggests Wall Street seems more excited about things like Bitcoin ETFs than these, in his view, fundamentally cheap gold mining companies. He even mentions he has a free report on his website, europac.com, that goes into his whole investment case for the miners in more detail.
Staying on this theme of his warnings, stagflation has been a big one for him.
Consistent, yes.
And those recent numbers from the University of Michigan survey, the big drop in consumer confidence, but inflation expectations soaring. That really seems to fit his narrative, doesn't it?
It really does. He looks at that data and basically says, see, stagflation isn't a risk anymore. It's here. It's undeniable.
Right.
And that directly contradicts what the Federal Reserve has been saying, about inflation expectations being well anchored or under control.
What were those numbers again?
The one-year inflation expectation jumped to 6.7%. That's the highest it's been since, 1981.
Wow.
And even the longer-term expectation is at 4.4%, which is more than double the Fed's 2% target. So yeah, he sees those as very significant red flags.
He doesn't sound like he has much confidence in the Fed's reading of the situation.
Not really, no. He often brings up past instances where Fed officials, including Chair Powell, downplayed risks.
Like
That downplaying stagflation risks now, similar to how they, dismissed worries about subprime mortgages before 2008, or insisted inflation was just transitory back in 2021.
History repeating?
He seems to think so. He argues the Fed doesn't really have a credible plan for stagflation. He even points out that their bank stress tests, the scenarios they run to check bank health, haven't really factored in a situation where we have both a recession and rising interest rates simultaneously.
Which could be dangerous if it happened.
Well, he suggests it could expose major vulnerabilities, maybe even widespread insolvencies in the banking system if that scenario plays out.
And how does that loop back to gold?
He connects the dots. He suggests the move into gold isn't just about inflation, it's also about a growing lack of trust in the conventional banking system. People and institutions looking for tangible assets, real safety outside that system.
Got it.
And again, who benefits if people want physical gold? Especially central banks. The miners. They're well positioned for that increased demand.
It's interesting. He also mentioned Larry Fink, right? The BlackRock CEO.
Yeah, he brought up reports that Fink has been talking to other CEOs, and the sentiment is that the U.S. might already be in a recession.
Which is something Schiff has been saying for a while.
Exactly. Schiff's view has long been that we've effectively been in a recession, but it's been hidden or masked by inflation numbers that he believes understate the real price increases.
So looking ahead, he doesn't sound optimistic, whether it's, Trump or potentially Harris in charge.
No, he generally anticipates the economy worsening and inflation staying high or getting higher under either administration. He does think Trump's trade policies, the tariffs specifically, would likely accelerate the negative trends.
But the underlying direction is the same, in his view.
That seems to be his core argument. The fundamental issue he raises is whether this trajectory, this path we're on, can even be turned around at this stage.
Which brings us to the Federal Reserve. What can they even do? They seem kind of stuck, don't they?
They really do. Schiff argues their main job should be fighting inflation, which means raising interest rates.
Right, the standard playbook.
But he doubts they can actually do it, at least not significantly, because the financial system, the government's own finances, are just too vulnerable to higher rates.
Too much debt everywhere.
Essentially. He points out that even when the Fed claimed it was being restrictive in the past, credit kept growing. So policy was never really that tight in his view.
Didn't he mention Alan Greenspan? Something about gold prices?
Yeah, he brought up Greenspan's old comments. Apparently, Greenspan used to say that if gold approached like $400 an ounce, it was a signal that monetary policy was too loose.
And now it's over $3,000.
Exactly. So the fact that Powell was cutting rates when gold was already past $2,000 and now it's way higher, Schiff sees that as a massive policy mistake. Driven, he thinks, by the simple fact that the economy and the government literally can't afford significantly higher borrowing costs.
So if they can't raise rates much, what does he think they will do?
He expects that as the economy weakens further, the Fed will eventually cave. They'll reverse course, cut rates again, and probably go back to quantitative easing QE.
Printing more money.
Basically, yeah. But he warns that this will just pour fuel on the inflation fire and weaken the dollar even more.
And jobs.
He expects widespread layoffs, particularly in the service sector, as imports become more expensive or harder to get.
So lower rates short term, maybe, but higher inflation and a weaker dollar long term.
That's the gist. And interestingly, he thinks even if the Fed cuts short-term rates, long-term interest rates will likely keep going higher because of inflation fears and maybe concerns about U.S. debt.
Speaking of U.S. debt, the Treasury market seems shaky too. You mentioned China potentially selling U.S. bonds?
That's a really critical piece of this puzzle. Schiff emphasizes the worrying signals coming from the Treasury market. The risk is that major holders, like China,
Uh-huh.
or even allies like Germany, who've been talking about bringing more of their gold home, might start reducing their holdings of U.S. Treasury bonds,
Why would they do that?
partly due to the trade tensions, wanting less exposure to the U.S., partly just wanting more financial security, having assets closer to home, or in forms like gold that aren't dependent on U.S. policy.
And if they start selling treasuries in large amounts, what happens?
Well, if global confidence in U.S. government debt starts to really crumble, the impact could be enormous. For the U.S. financial system, for the dollar, for interest rates,
Hmm.
it could be severe.
Sounds pretty grim.
It does for the U.S., but here's where Schiff has a somewhat maybe counterintuitive take.
Oh.
He believes this next financial crisis will be heavily centered on the U.S., maybe worse than 2008, for the U.S. specifically.
Okay.
But he thinks for the rest of the world, it could actually be a period of liberation, maybe even an economic boom elsewhere.
Liberation, how does that work? A U.S. crisis being good for others.
His argument is this: if the U.S. is forced to consume less and save more, then other countries won't need to gear their economies so much towards producing cheap stuff for Americans.
Right.
And they won't need to lend so much money to the U.S. government and consumers. This frees up their own capital, their own resources.
To invest at home.
Exactly. Invest in their own markets, build their own infrastructure, let their own people consume more of what they produce, strengthen their own economies, independent of the U.S. gravy train.
So he sees the current move into gold not just as a temporary safe haven thing, but a real long-term shift.
Precisely. He characterizes it as a fundamental structural change in global finance, not just a fleeting panic.
And his price target for gold? You mentioned $20,000. Seriously.
Yeah, his outlook has gotten way more bullish. He's thrown out numbers like $20,000 an ounce, maybe even higher.
That sounds astronomical.
It does, but he's careful to add context.
Yeah.
He emphasizes that a huge chunk of that price increase wouldn't necessarily be gold becoming intrinsically that much more valuable in real terms.
But the dollar becoming less valuable.
Exactly. It reflects a massive potential devaluation of the U.S. dollar itself.
Yeah.
He contrasts the dollar's stability when it was backed by gold versus its dramatic loss of purchasing power since we left the gold standard.
Does he think we could actually go back to a gold standard?
He envisions a potential return to something like that globally. Maybe not the exact old system, but one where major currencies are backed by gold again, providing stability. Like things were before the Bretton Woods Agreement made the dollar the center of everything after World War II.
And that ties into countries wanting their gold back physically.
Absolutely. If you think gold might back currencies again, or if you're worried about the U.S. potentially using financial sanctions, you want your gold bars sitting in your own vaults, not somewhere else. Security becomes paramount.
Okay, so outside of the gold miners, does he point to any other areas, other opportunities in this changing landscape?
Yeah, he does mention a couple of things. Foreign dividend-paying stocks, he notes, have actually been performing quite well recently.
Interesting. Any sectors?
He also suggests there might be value in energy companies and potentially other mining sectors beyond just gold.
Even though the market seems worried about a global recession.
Right. He thinks the market might be pricing in a global slowdown, but his view is more nuanced. He anticipates maybe a deep downturn, even a depression in the U.S., but potentially a boom in other parts of the world as they decouple,
And emerging markets.
especially emerging markets. He sees them as having potentially the most to gain from a weaker dollar, particularly if their large amounts of dollar-denominated debt become less burdensome.
What about the U.S. government itself? Could it start buying gold, adding to Fort Knox?
He thinks that's highly unlikely, simply because, in his view, the U.S. is effectively broke, running massive deficits, huge national debt. Where the money come from?
Right.
He points out the countries currently buying gold are the ones with big trade surpluses. They have the excess cash to do it. The
Yeah.
U.S. doesn't.
And definitely no strategic Bitcoin reserve, I assume.
Oh, he dismisses that idea completely.
Yeah, speaking of Bitcoin, his view hasn't softened there at all, has it?
Not one bit. He still consistently calls it things like a digital pyramid scheme or a Ponzi chain letter. Definitely not digital gold in his book.
What's his main argument against it now?
He likes to highlight its performance relative to gold, especially recently. He points out Bitcoin is down significantly, maybe 30% against gold since Bitcoin's peak back in 2021. He calls that a stealth bear market for Bitcoin when priced in real money, i.e. gold.
But people always point to the huge returns since it was created.
And he dismisses that argument. He says that's typical of any bubble. Massive gains early on don't prove long-term value. He still predicts it will eventually collapse.
What if gold had just been invented today? Would it look like Bitcoin? That hypothetical comes up sometimes.
He tackles that too. He argues no. He believes gold's fundamental physical properties, its history, its real-world uses, its inability to be easily replicated make it unique. He doesn't see Bitcoin as replicating those core attributes at all.
So, wrapping things up then, his overall outlook for the U.S. economy sounds, well, pretty bleak. Stagflation confirmed.
Confirmed, yes.
Yeah.
But he warns it's likely to be much, much worse than the 1970s version. He uses terms like depression combined with very high inflation.
That sounds awful, but necessary in his view.
He frames it as a painful but necessary correction, a consequence of decades of what he sees as economic imbalances, the trade deficits, the government budget deficits, the hollowing out of the U.S. industrial base.
So, what's the solution then? How do we fix it?
His prescription is basically austerity, a return to fundamentals. He talks about needing to go back to work, stop overspending, both government and personal, dramatically increase savings, and focus on rebuilding domestic production. Hard medicine.
And he sees two paths.
Yeah, basically. One path is accepting that difficult adjustment, going through a period of constructive austerity that could lead to genuine long-term recovery and strength.
And the other path.
The other path is trying to avoid the pain with more of the same policies, more debt, more money printing, which he believes will just prolong the agony and lead to even worse outcomes down the road. He doesn't sound very confident in the current policy direction or the advisors involved. He thinks there's a fundamental misunderstanding of the U.S. economy's real problems.
Wow. Okay, so bringing this all together, we've definitely seen this convergence, haven't we? Record gold, a shaky dollar, those trade tensions flaring up, and inflation data that's, well, pretty concerning.
Yeah, it really does paint a picture of a potential major turning point in the global economy.
And Peter Schiff's analysis, whether you agree with all of it or not, certainly argues that some deep fundamental changes are needed in the U.S.
Absolutely. His core message is that the long era of the U.S. dollar's absolute dominance might be facing its biggest challenge yet. And the fallout from that, well, it could reshape global finance and have real implications for everyone's financial future.
It definitely leaves you with a lot to chew on. It's worth considering, as Schiff suggests, what would a world where the dollar isn't the undisputed king look like? What might that mean for your own approach, your own understanding of how the global economy works?
Good questions to ponder. And listeners can find more of his detailed analysis over at europac.com if they want to dig deeper.
Well, thank you for joining us for this deep dive today. We hope trying to unpack these complex, fast-moving issues has provided some clarity and perspective.